Good day, everyone, and welcome to our webinar for October 2022. We'll begin as usual in America. Obviously, it's now apparent that there is entrenched inflation in America. It's deeply entrenched in the economy. The core PCE rate was 4.9% year on year and 0.6% just for August month. This shows that the rate hikes, which have so far totaled 3%, are nowhere near enough for what will be needed. The Fed wants to bring inflation down to 2%, and real rates of return in America are still negative and will remain so for some time. This means that more rate hikes are almost certain. The Monetary Policy Committee hiked rates by 75 basis points the other day, and that's the third such hike this year. The hike was well anticipated, but Jerome Powell's remarks were not. He said getting inflation down was more important, in fact, than unemployment. So he said that the labor market was too tight and that demand must be curtailed. With those remarks, the S&P collapsed. And on Friday, sorry, let me get this off here. On Friday, which was this day down at the bottom of the chart, which you see here, the 30th of September, the market collapsed well below its previous low point at 3666, which you can see over here. So it collapsed down to 3585. So now what we have is a pattern of lower tops, falling tops on this chart, and falling bottoms. All right, that's now a lower bottom than this bottom, and it'll probably go lower still once this little bounce is finished. And the chart is very instructive because it shows you the support and resistance levels at 4170, 3900, and now we're getting a new level at 3666, which we've had since that bottom on the 16th of June 2022. So on Monday and Tuesday, the S&P bounced, as you can see. That day was up, and then yesterday, last night, it rose by an amazing 3%. And this is because of a report that came out yesterday about the job openings in America. July's job openings July's job openings were 11.2 million, and in August that fell to 10.1 million. So that was a pretty dramatic fall. And all the bulls said, this is going to mean that we won't have to push interest rates up as quickly. The Fed will be more dovish. And so they've been driving markets up ever since. So this resulted in a 3% jump last night, on top of a 2.5% jump the day before. And I think this looks very much like what we call a panic rally. There's an air of desperation about it. I do not think it will last very long. I think it will almost certainly run out of steam and turn negative fairly soon. But we're in a phase now where bad news is good news. I don't know if you've noticed that. So if there's bad news about the economy, like this job openings report, it's good news for the share market, because people say, well, this bad news is going to mean that they're not going to push interest rates up so quickly, and that in turn makes shares more attractive. I've seen this many times before, and I do not expect it to have any legs. In other words, we're going to have a little bit of a rally, but I don't think it'll last. I think at best it will get back up to this 3,900 support and resistance level up here. So now the question remains, how far will the bear trend go? On average, bear trends fall about 50%, so that takes the S&P 500 down to 2,400 from its high of 4,796, which you see on the chart here, which was made on the 3rd of January, over 9 months ago. If we do 50%, we'll be down at 2,400 or just around about that level. But this bear trend could be far worse than that. The Fed is busy trying to reduce the size of its balance sheet through quantitative tightening. Nobody really knows what the effect of that will be because it's never really been done on this scale before. You just have to keep in the back of your mind that the 1929 bear trend took the Dow Jones down to just 11% of its peak value. So that's something you need to think about. That is a possibility. I'm not saying it will happen, but it's certainly out there at the moment, depending on the effect of this reduction of the Fed's balance sheet. Now, you may have noticed on the chart that we've superimposed a 300-day simple moving average here. You can see it's this blue line. And what's important about the blue line, about the simple 300-day moving average, is its slope. So you can see over here it was sloping up, and then up here it turned down. It turned and started moving downwards. And that is a very conservative indication of a bear trend. You can see that the rally that we had between the middle of June and the middle of August did not result in that 300-day moving average turning up again. It continued to fall. So that indicates that we are in a bear trend. And of course, when this turned down, that was when I accepted and we accepted that we were in a bear trend, and we sold out of our entire equity portfolio at that point. And I might say that all the shares that we sold are now lower than they were at the time that we sold them at this stage. So that's validating our position. Now, another mechanism for determining whether you're in a bull or a bear trend is to look at the moving average against the current share price chart. And that is done in the overbought, oversold indicator. So I'm just going to lift that up from the bottom of the screen here to show it to you. Right, this is an overbought, oversold. And I'm going to put all the data on the screen here. And I've put in some annotations for you. Now, an overbought, oversold indicator measures the degree to which the share price has departed from its moving average, in this case, the 300-day moving average. The logic is that when the gap between the moving average and the price is at its greatest, on the downside, that is the best time to buy, and when it's at its greatest on the upside, that's the best time to sell. The benefit of this is that it gives you an oscillator, as you can see on the screen. You can see the blue line in the middle here. That's the zero line. And the OBOS oscillates above and below that constantly. And if you have a lot of history, as we have here, I think this is 33 years, goes back to 1989, you can get an idea of how high up and how low down the overbought, oversold will go. In fact, the overbought, oversold is an indicator of the market's overreactions. How far does it overreact? So looking at this chart, we can see that the S&P 500 against the 300-day moving average has the propensity to overreact to plus 22%. That's why I've put this upper limit line in here of about plus 22%. Doesn't go really above that level. On the downside, it generally goes down to somewhere around 13%, minus 13%, or somewhere in that zone. So this gives you a very good idea of whether you are overbought or oversold at any point in time. And you can see I've marked in some things here. Here's the 1998 dot-com crash, for example. And you'll notice that came from the bull market right up here, which was well above the plus 22 limit, and down it came. This was the 9/11 attack on the World Trade Center in 2001. And you'll notice that the overbought, oversold remained below the buy line for quite a lot of that time. And when this remains below the buy line, of course, the index is still falling. This is the subprime crisis in 2008 here. And again, you can see it broke down through that buy line very severely, went way down, and then came back up again. And then this is COVID-19, which we had, of course, this is about March 2020. And now we are, and after COVID-19, it went up, touched that plus 22 line again, and then started falling back. And you can see here, this by the way is that little bear market rally that we had for 2 months between the middle of June and the middle of August. You can see that didn't even get the oversold back up to zero, and now it's falling again. On Friday last week, before this little bounce that we had on Monday and Tuesday this week, it reached minus 16.79%, so well below that minus 13% level. So I hope that gives you some idea. The Overbought Oversold is available on your software. In fact, it's at the bottom here. You can see it there, the OBOS. And you can put it on and choose your period, choose your moving average that you want to have it against, and so forth. If you need more of an explanation on how the Overbought Oversold works, then I suggest you go back and reread Module 27 in our lecture notes. Last Friday, the market fell 1.51%, and of course it went down through that key support level at 3666 and closed below that level, which is significant. This does not mean that it's a good time to buy. The market may well fall further. I'm not buying yet. The OBOS can remain below that minus 13% buy line for quite a while. And while it does, the index must still be falling. We believe that this bear market still has considerable distance to run. The other thing, of course, that you can see here is that the index does go up to that plus 22% limit line. And it's amazing. It always amazes me that it does go up there, but it does. And of course, that means that somebody is buying at that high level. And looking at this chart, you can see that their statistical probability of making money or being right by buying above 22% is extremely low. Statistically, they've got a very, very low probability of being right. So this is what the OBOS does, the Overbought Oversold. It improves your probability of being right by telling you where you are in the market cycles. So I hope that gives you some indication. I will come back to that OBOS again at the end of the talk because I want to apply it somewhere else. So now the S&P 500, I'm just going to take this OBOS off here and go back to the current chart, which is this. Maybe put a little bit more on just to show you the situation. There's the bounce that we had over the last 2 days that we were looking at just now. Now the S&P 500 is on a forward price earnings ratio of 16.8, so that's well below the peak of its forward PE, which was 22. The S&P 500 companies are expected to increase their earnings by about 5% in the third quarter. Bearing in mind that the third quarter has just finished, obviously, at the end of September, and we are now going into what's called the third quarter earnings season in America, where those companies will be producing their quarterly reports for everyone to see. What's noticeable is that, as I said, S&P 500 companies expected to increase earnings in the third quarter by 5%, but most of that is energy. If you strip out the energy, then the expected increase in third quarter earnings is actually minus 1.7%, according to analysts in America. Most of the losers will be consumer spending and financial shares, in their opinion. So it seems unlikely at this stage that the 3% interest rate hikes which we've had will have much impact. Not yet. They're not going to impact on corporate profits just yet. But as interest rates continue to rise, and remembering that interest rates have a cumulative impact on sales and earnings, you can expect this effect to become more and more powerful. Bearish sentiment is hitting all markets around the world, including the JSE. Sentiment has shifted very strongly towards risk off from risk on. And that, of course, has a directly negative effect on the JSE, and it has a direct effect, of course, on the Rand, which we'll talk about later. I just want to pause now. That's really what I have to say about the United States. But now I just want to talk a little bit about China, because China is quite an important country. China now has a GDP which is about 3/4 or 75% of the United States of America. It's a considerable force in the world economy. And the World Bank has just adjusted its prediction or estimate of growth in China down to 2.8% for this year. And that's down from 5%, so they nearly halved it. Next year, they've trimmed the growth from 5.3% to 4.5%. This is quite a radical slowdown in China. Of course, part of this is due to the very strict lockdowns which they're having in China due to try and control COVID-19. Companies like Barlow World have been affected. Suppliers of mining equipment have dropped off substantially. In fact, the Barlow World new order book has fallen by 2/3 since the start of the Ukraine war. That's quite an amazing statistic. And that, of course, brings us on to Ukraine. The recent successes of the Ukrainian army in the northeast have been a major blow to Russia and, of course, to Putin's dictatorship. It's very difficult to maintain an image of winning the war when they are losing territory. The disinformation campaign which Putin has been running inside Russia is beginning to fall apart. There are rumblings of discontent from within Russia, from among the Russian people, especially since his latest effort to conscript a further 300,000 soldiers. This has not been popular. There have been suggestions that he must go. And of course, all this time, Western sanctions are really beginning to hammer the Russian economy. It's notable that without the sanctions, it's estimated that the Russian economy would have grown between 5 and 6% this year. As it is, Putin himself estimates that the economy will shrink by 2%. His economy ministry says it will shrink by 3%, and the World Bank says it will shrink by 11%. We believe that Russia's position is now unsustainable. A radical change will be forced on Putin within a few months, in our opinion. The mobilization is an acknowledgement of how bad things are going. And it may well backfire on him, destroying what popularity he had previously enjoyed. The rushed and illegal annexation of the 4 provinces in Ukraine is also further evidence. So we believe that the Ukrainian situation will be resolved fairly soon, within months rather than years. And that when it is resolved, Putin will probably not survive. Okay, let's turn our attention now to South Africa. On the political front, of course, the ANC elective conference is looming large in December. It looks like Ramaphosa will be re-elected fairly easily. He's recently had endorsements from Limpopo and from the Northwest Province. He's widely expected to get an endorsement from Gauteng, from the Eastern Cape, and Mpumalanga and the Northern Cape. Phala still remains a problem for him, but it is being resolved apparently, and it does not look like it will force him to step aside. So that means the political status quo in South Africa will probably remain in place at least until the 2024 general election. At that point, we believe the ANC will lose its majority and will probably be forced to come to some kind of compromise with the DA. They are the only party that is big enough and not too radical or close enough to Ramaphosa's policies for some kind of an agreement to be possible. So we don't think that's a bad thing. We think that an amalgamation with the DA will result in a more sane management of the economy than has already been in place. COSATU, of course, is reconsidering its support for the ANC and the tripartite agreement. They're calling a special conference in 2023 to reconsider their position. 4 COSATU unions are calling for the withdrawal of COSATU from ANC support. If that happens, of course, it will reduce their support even further in that 2024 election. Right, let's look at the economy. The Reserve Bank predicted that GDP would be down 1.1% in the second quarter. It in fact came in down 0.7%, so that was a little bit better than they were expecting. This was, of course, due to the Natal flooding, load shedding, mining sector strikes, and also the petrol price. Also, of course, interest rates were up, and so that was a negative, but it came after the first quarter's growth of 1.7%. The third quarter, which is coming up now, will obviously be bad, mainly because of 25 days of load shedding. The negative impact on GDP is anticipated and is also obviously negatively affecting the long bond, the yield on the long bond, and the rand. Our growth this year, however, is still expected to be about 1.9%, and that will be way ahead of America's expected 0.2% growth this year. In fact, the Reserve Bank has done an excellent job of managing the economy over the past 20 months, right through the COVID-19 period. Inflation in August fell to 7.6%, down from July's 7.8%, and it may be topping out. Despite this, the Monetary Policy Committee raised interest rates by a further 75 basis points, and 2 out of the 5 members of the MPC wanted to raise rates by 100 basis points, by 1%. So it was only just carried at 75 basis points. Obviously, we have to keep pace with rising interest rates in America and in other parts of the world like Europe, in order to keep our bonds attractive to overseas investors. Core inflation fell to 4.4% in August from July's 4.6%. Mainly, of course, that is due to oil. The producer price index also fell slightly to 16.6%. But of course, remember that PPI includes a 37.6% increase in fuel and an 11.6% increase in food. So it's actually not bad at all. Retail sales were up, surprisingly, in July by 8.6% year on year. But of course, that comes off a very low base of July 2021 when we had all that civil unrest in Natal and Gauteng. But sales have been falling for the past 3 months, mainly as a result of the load shedding and also the higher petrol price. This shows that consumer spending is declining, and you must never forget that consumer spending in South Africa is 2/3 of our gross domestic product. Foreign domestic investment dropped sharply in the second quarter to 26 billion rand from 40 billion rand in the first quarter. The Ukraine war, of course, is having an impact. There's been an international shift towards risk off. And of course, we have falling commodity prices. So those are the mainly reasons why FDI came off in the second quarter. Mining production fell by 8.4% in July after June's 7.1% decline. So mining production is falling quickly. This is due obviously to load shedding in some places, strikes in other places, and of course mainly due to a fall off in commodity prices. The commodities boom is rapidly coming to an end. Platinum has fallen from $1,300 an ounce in February 21 to current levels around $860 an ounce. Tax revenue, this in the October budget, which is coming up now, should be between 50 and 100 billion above the February budget, but that bonanza is rapidly coming to an end. The iron ore price has fallen from $161 a ton in April 2022 to below $100 a ton. The balance of payments moved into an 87 billion rand deficit in the second quarter. That was a big surprise. Economists were expecting a 100 billion rand surplus. But of course, that is largely due to the fall off in commodity prices. And this, of course, keeps the pressure on the Monetary Policy Committee to keep raising interest rates. The governor of the Reserve Bank, Letsetja Kanyago, says the goal is to bring inflation back below 3%. He's urged the government to implement structural reforms to create jobs rather than trying to spend its way to higher employment. He said the economy is barely able to grow at more than 1% at the moment. It has a shrinking tax base and a weak outlook. So that's the governor of our Reserve Bank saying that. In our opinion, he is the one who should enter the ANC's December leadership contest. Let's turn our attention quickly to Eskom. There's been a sudden escalation of load shedding, of course, in September, which is putting a huge strain on the economy. It must result in lower GDP growth and obviously in higher unemployment. It shows just how fragile Eskom is. Systematic corruption and incompetence in that company still. Eskom is busy buying 1 gigabyte of power from companies which have installed capacity. I don't know why they didn't do this a long time ago. And they're re-employing 18 previous Eskom employees who've got decades of experience but have left the company for various reasons. I'm sure we all know who those kind of people are. And the idea is that they need these people in order to get the system working again. Electricity availability in September was just 60%. The National Energy Regulator of South Africa has been slow in registering renewable energy projects. In fact, if you just look at the mining industry, 29 mining companies have 89 projects which they've put to NERSA, to the National Energy Regulator, looking for permission. And those projects between them would generate 6.5 gigabytes from renewable sources. Only half a gigabyte has so far been accepted and licensed. But if they'd licensed all of that, that would have given us an extra 6 gigabytes of power, more than enough to avoid the current load shedding. And you can understand the load shedding in September is having a major impact on business. Quite a few businesses are not going to survive this. So it will lead to higher business failures, and that, of course, inevitably leads to higher unemployment. Economists are now expecting third quarter GDP growth to come in at about 0.5%, and that's down from the 2% that they previously expected. In our opinion, the decision to restructure the Eskom board is kind of like changing horses in midstream. We do not believe it will have a major impact on electricity availability. And of course, in the background, there is Eskom's decision to ask for a 32% hike in Eskom tariffs in this year, which seems to us completely absurd. Of course, the rand is reflecting all these things, and the weakness in the rand really reflects the shift towards risk off in international investment sentiment. It also reflects the relative strength of the US dollar against all currencies. The euro and the pound have also fallen against the US dollar. In my view, the rand has actually held up extremely well in the circumstances. You will have noticed, however, that whenever Wall Street strengthens, then the rand strengthens as well, because there's a shift back towards risk on. In fact, just the last 2 days, you can see Wall Street went up very nicely. If we go and look at a chart of the rand, you'll see that it reflects a similar kind of thing. So there's the rand, and you can see in those last 2 days when Wall Street was going up, the rand was getting stronger. And it closed last night at 1760, so well down from this peak up here of 1808. And that is obviously the shift towards risk on from risk off. But it's an interesting relationship and one that you should just keep in the back of your mind. All right, let's turn our attention now to the companies. Of course, we're in a bear trend, and the bear trend is gaining momentum, as I said. Most private investors should be substantially in cash at this point and should be watching the market closely in order to pick the bottom, to buy high-quality shares when they are cheap. We believe the bottom is not imminent. But of course, we can be wrong. We have been wrong in the past. Finding the bottom depends very much on how risk-averse you are. You can, of course, look at the S&P 500, and you can say, let's put that 300-day moving average on and look for a change in the direction of the slope of the S&P 500, of the moving average on the S&P 500. Just want to pull this down so that you can get a bit better picture. and put on that 300-day moving average again. Click, 300 days. Say okay, right. And there you can see this moving average, this long moving average is falling, and there's no sign of it turning up anytime soon, in my opinion. When it turns up, we will almost certainly be in a new bull trend. The problem with using the 300-day moving average is that it's quite slow, so you get that signal quite late. And so it would suit somebody who is risk averse, who doesn't want to take too many chances. A more profitable moving average would be the 65-day exponential. So if you go to your charts down here and just go one down, go to the exponential moving average, there it is, and you can just put a 65-day on here like this. And, sorry, we've gone back into that mode. You know what? Let's just delete that indicator and then we'll be okay. So I need to put on those moving averages again. Okay, there's the 300-day coming in. And then I put on the 65-day again. There it is. Click on that. And there's your 65-day. Now, what you'll notice is that the 65-day, of course, follows the index much more closely, but it gets whiplashed. So it would have got you back into the market over here, out over there, in again there, out again there, and now we're down here. So it's quite sensitive to movements in the index itself. The 300-day moving average, as you can see, is not sensitive at all. And exponential moving averages are weighted. If you think about a normal moving average, every day in the period has the same impact on the position of the moving average. So if you have a 10-day moving average, each one of those 10 days, the prices on those 10 days, has the same impact on where the moving average is going to be. And some analysts believe that this is not logical, that the more recent days should have a greater impact on the position of the moving average than the oldest days. And you can imagine, with a 300-day moving average, maybe they've got a good point. So what you do when you weight a moving average is that you weight the more recent days more heavily. And you can weight them in various different ways. You can weight them in a linear fashion. So you can say, okay, if we're dealing with a 10-day moving average, we'll take the oldest day, the 10th day, and we'll multiply it by 0.1. And we'll use that number. The second day, we'll use 0.2, 0.3, 0.4, right up to the previous day, which will be weighted at 100%, at 1. And then you make an average based on that. If you do an exponential moving average, you weight it even more severely, so that the oldest days have even less impact and the more recent days have even more impact. I find an exponential moving average is very useful, a 65-day exponential moving average, very useful when you've had a sharp fall in the market like we have had. And you can see that even with those days where, the 2 days where it bounced, we're still quite far away from the 65-day exponential moving average. So that's the thing that you've got to bear in mind. And if you want to be even more risky, but have even greater potential for return, then you can use the overbought, oversold. And we'll look at that in due course again. So now I want to talk about Capitec because, what we're saying is that high quality shares at the moment are falling, right? They're falling, and some of them represent good buys at the current level. So I just want to minimize that and maybe pull in a bit more data here. All right, this shows you that Capitec peaked at 2,383 Rand a share up here. And since then, it's been in a downward trend, and that downward trend accelerated when the bear trend became apparent. So from about September, the first week of September, Capitec started to collapse. The reason for this is that Capitec has been on a very high price-earnings ratio. You can see before it started that collapse, it was on a PE of over 28. You can see that up here. There's the PE there. So there's your PE at 28. And that makes it vulnerable to systematic risk, to a fall in the market as a whole. And you can see the entire market has fallen, as we've been discussing. And now investors are getting scared that Capitec is overpriced. It's a very good share. It's got fantastic profits. It's growing its market share. Everything about the company is great, but the market itself is falling. So it's very important to understand that difference between systematic factors, which have got to do with the market as a whole, and unsystematic factors. So you can buy a really high quality share like Capitec, and it will fall anyway, just because the entire market is falling. Not because of anything it is doing or any problems that it has, but because the entire market is falling and sentiment is turning bearish. And that's what's happened here. And you can see Capitec is falling quite sharply now. And so I applied a 65-day exponentially smooth moving average. And you can see how that moving average is coming down rapidly. And it's still well above this closing price of last night, which was 16.38. At its lowest point, it reached 1,553 Rand a share, which is a drop of about 34%, nearly 35% in fact. So, when a high-quality share like this has fallen 35%, as a private investor, you have to take an interest, because this can be a real bargain. I mean, one thing you have, if you buy it now at somewhere around these levels, you may not get it right at the bottom, but you're certainly not doing as badly as the guy that bought it up here for 2,373 Rand a share. You're paying a hell of a lot less than him, 34.64% less. We believe that the market will fall further, as we have said time and again. So therefore, we put on a 65-day exponentially smooth moving average, and we wait for one of two things. Either for the Capitec share price to break up through that 65-day E, or for the slope on the 65-day E to turn and start going up. That would be slightly more conservative. Of course, this is not as conservative as applying a 300-day moving average to the S&P 500 and waiting for the slope on that to turn up. That would be much more conservative. If you want to be even more risky and have the potential to make even more profit, then you will go to the overbought oversold, which we've been discussing earlier. So let me put on the overbought oversold for Capitec. Wait a minute, I want to just adjust this slightly. So what we want to do here is go to OBOS. OBOS. And I want to take out that 300-day, which we're using for the S&P 500, and put in 65 days. And now, let's take this back up again. Right. And then put all the data on the screen. Just not sure whether I've got this. This still doesn't look right to me. Let's try that again. Sorry for the delay. It should be right. Okay, what I want to show you on this chart. So this is the overbought oversold on Capitec, and it's going back 20 odd years to 2002. That's what we're looking at here. And you can see that this chart very seldom goes below minus 19%, right? So you could in fact draw in a line here from there and across, all the way across here. And that would be your buy line. You don't become interested in Capitec until it falls through that line. And here you can see Capitec has broken that line on a number of occasions. And right now, we are also down below that line. We are close to being down below that line. And that makes Capitec relatively cheap in historical terms, because you're saying over the past 20 years, it doesn't go below minus 19 except on a very few occasions. So your statistical probability of being wrong in buying it when it's below minus 19 is extremely low, And you have the great satisfaction of not being the guy who bought it over here when it was above plus 37. But somebody did. Somebody bought it up there. You see what I'm saying? So the overbought, oversold can improve your probability of being right. That's really what we're saying. If you're a risk taker, you could use the OBOS. If you are less of a risk taker, you can use the 65-day exponential. And if you're not a risk taker at all, you use the 300-day and you apply it to the S&P 500 and wait for the entire world market to turn upwards before you start buying these shares. But you will, of course, miss the bottom by doing that. But you'll have far more security. It's the age-old trade-off between risk and return. The more risky something is, the higher the return has to be in order to justify investing in it. Okay, I've got a few other things to talk about as far as shares are concerned. There's a new listing coming to the market. It's a special acquisition company, a SPAC. Its name is Psilocybin, Cilocybin, and it plans to list on the 22nd of November. It's already selling its shares. It's made a pre-listing share offer on the 12th of September in the hopes of raising about 2 billion rand. It plans to buy cannabis and cannabis manufacturing facilities in Pretoria. That facility apparently can produce about 150 million rands worth of product per month. And obviously we believe that cannabis and marijuana are a growth industry in this country. But our advice to you is don't buy pre-listing. Wait for the share to list, see what the share does on the market, then buy it. So that's the new listing for this time. Then I'd like to talk a little bit about Caxton. Caxton, of course, is a printer and a publisher in South Africa. They are basically at the heart of the displacement of hard copy by digital. So as people move away from hard copy magazines and into the digital era, that has a direct impact and is having a direct impact on Caxton. And as you can see, the share price was falling for a long time, made an island formation over here, then broke up and started a new upward trend. Of course, Caxton has been adjusting and reducing costs because of the steady erosion of their advertising revenue, but in their results for the year to the 30th of June 2022, their revenue climbed by 14.5% and headline earnings per share jumped by 108.2%. So we see this as a company with potential and one that's worth your attention. Okay, Truworths. Well, we all know what Truworths does, selling clothing and fashion items and accessories. We suggested in the last confidential report in September that this was an interesting share to look at. We still believe that. It's produced its financials for the year to the 3rd of July this year, 2022. Headline earnings per share fell 50%. The share price has fallen below 50 Rand here. But if we look at the long-term chart, you can see that it peaked at 110 Rand, came all the way down here. We put on the trend line. We advised you to wait for a breakup. That breakup came over here at about 31 Rand a share. It's now moved up to this level where it's at around 51 Rand a share. It's sitting on a PE of 6.54, which is pretty good. It's very, very cheap. And a dividend yield, more importantly, of 7.92%. So they're offering dividends. So this is a big blue chip retailer that's got a long proven track record, and it's looking very, very cheap indeed to us. Okay, let's talk about Hyprop. We have for some time by now been saying that property shares on the JSE are cheap. They're probably the cheapest shares on the JSE right at the moment. Their net asset values are way above the current prices, sometimes double or even 3 times. Hyprop, of course, owns Rosebank, Hyde Park, Clearwater shopping malls, and a number of others. It's been impacted by the fall-off in consumer spending, but it's got a net asset value of 60 Rand, and the share price is about 35 Rand, nearly half price. In its results for the year to the 30th of June 2022, it told us that it had a loan-to-value of 36.4, which is reasonable, but headline earnings per share were up 34.9%. As you can see from the long chart, here again, we had a downward trend in this share, an island formation, an upside breakout, and since then a steady upward trend in our view. Again, we think that this share is probably cheap at current prices. But remember, in the background to all this, we are in a bear trend. You must never lose sight of that. Okay, the next share I want to look at is Sappy. This, of course, is a big international manufacturer of dissolving wood pulp, or DWP. It sells this product in 150 countries. That product, DWP, is used to manufacture clothing and manufacture packaging and also in other applications. The price of DWP has fallen sharply around the world. And that's mainly linked to what's going on in China. On the 29th of September, they said that they'd sold 3 of their European DWP mills for 272 million euros. So obviously that will help to bring their debt down. And you can see here that the share was in a downtrend. There's COVID-19. And then since then, it's been moving up, trending up. And we think that it's relatively cheap at the moment and probably will be moving up from these levels. All right, storage, another property share, the last one that I'm going to talk about today. This company is a very interesting share. It's been performing well on the JSE for quite a while. Obviously it's a real estate investment trust, specializes in domestic storage, both in South Africa and the UK. It's about 60% in South Africa, 40% in the UK. Something of a rand hedge there. It's got about 74 properties worth 4.7 billion in South Africa and properties in the UK worth about 2.9 billion. Its loan to value on the 31st of March this year was just 27.9%. So it's got a very strong balance sheet. In a trading update on the 31st to the 31st of August 22, rental revenue was up 6.7% in South Africa and 10.8% in the UK. The chart shows that the share has been in an uptrend, but has been in a downward trend since this bear trend began on world markets. So this is one of those shares that you need to watch because it's looking like it could become really good value. It's fallen 11% so far, and we think that it's looking more and more attractive as it falls. Okay, folks, that's about all I've got for you today. I hope that you found something in there of interest. I will be doing another presentation on the first Wednesday of next month, November. So I look forward to talking to you there and thank you very much for listening to me.